Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. Scott Hansen.
Pat McClain, thanks for joining us.
Yep, and what a week financially.
Yes, we are taping this Thursday, November the 7th. Not taping it, we're storing it in some digital form.
That shows how long we've been doing the program, because it used to be like these.
Little cartridges.
They were like 8-track things.
So Thursday, November the 7th at 12:30 Pacific time.
Yeah,
so
just to give you some idea.
Context
in case something
where
weird
we're
happens
at.
on Friday. But
yeah.
And
interesting.
We're not going to talk about the election because there's 8 million shows you can listen to talk about the election.
I do want to talk about the market,
of course,
the day after the election,
of course,
and why it absolutely doesn't matter. Why it makes no difference whatsoever that the market was up 3.5%. Over the long run, it will even itself out.
Yes.
So let's talk about it now. Right? I was at the gym this morning, and you're thinking, Pat goes to a gym? Yes, because the bathrooms are cleaner and the TV's better. So I was at the gym this morning, and they were talking about the markets, and I said, you know, this is exuberance that may or may not be well placed. It is exuberance that doesn't matter in the long run, because what matters in the long run for stock market, Scott?
Growth of I might differ with you, but growth of the economy.
That's right.
And growth of profits. Obviously, it's all based on discounted cash flows, and what a company's going to earn in the future.
Yeah, and the cost of money.
But the markets might be saying, well, clearly, we believe, whether they're going to be right or not, we believe that under this administration, the results of the election, that the future profits of companies are going to be better than otherwise.
But
that's why they and maybe it's further than that. It was a clear call. It wasn't like we're going to be in weeks of
which I expected.
And is someone going to not concede and all that other stuff. Right?
Which I clearly I thought, well, this thing could go on for months, right? You think about Bush in Florida and all those things.
I think a lot of us were concerned about that.
But over the long run, and it surely was a sign that, hey, a group of investors, not all investors, but a group of investors felt that this was better for corporate profits than the alternative. But over the long run, it makes no difference.
What happened yesterday?
What happened yesterday? That's what I mean. What happened
with
yesterday?
The markets.
With the markets, yes, over the long run. Yeah. What happens to business is under one administration versus another, there's certain, I mean, you could tell that by, if you don't think government plays a role. We live in the state of California. Look at all the Fortune 100 companies that have left the state of California because of
lots of reasons.
Lots of reasons, but mostly policy reasons from the government. They have left the state of California. So that does tell you that how a government acts does affect how a company will actually perform or where they're most certainly located.
Someone had said that the increase in the market swing on Wednesday, that was up 1,500 points.
Which is a big...
So like, this is the largest increase ever. Not on a percentage point.
Not on a percentage point, right?
It really wasn't. It's the biggest percentage point increase we've had in 2 years, to put things in perspective. We had some day 2 years ago, I have no idea which day that was, where the markets were up the same. But as we continue to go higher with the Dow, we're going to have a 1% point swing is now, we need 400 points.
Yes.
To get a 1% swing.
Yes. Like, oh, so what?
Yeah, so having and 1% swings are very common. But I was thinking, as we continue, it's not going to be that long before we're at Dow 100,000.
No.
Sometime in the next 10 to 15 years.
Yes.
And if the stocks perform as they have historically, it'll be about 10 years.
Yeah. And then they're going to reprice the whole Dow.
Split,
carve it up, split the Dow. No, it's where we're at.
Yeah. Anyway, we're happy to be in the studio here talking about financial stuff and answering your questions and taking your calls. One thing, Pat, before we do that, one of the big question marks in people's minds was the whole estate planning issue.
Yes, wanted to talk about that.
Because it was part of the Jobs Reduction, not Jobs Creation Act, Jobs Act of some sort. Obviously not Jobs Reduction Act, but no one would call it that, even if that was the result.
Everything's got a really positive name.
Yeah, but all the tax cuts, the Trump tax cuts that were set to expire December 31st, 2025.
They were temporary. They were set to expire.
But considering that 52 senators,
yes,
as of the time right now, we don't know who's going to win the House, but it's certainly looking likely it's going to be high likelihood that they're not going to change much.
No, in fact, I would expect that the only thing they're going to do is probably extend them and not actually make them permanent.
My mic off. They can't make them permanent.
Yes, because then they'd actually have to adjust the budget to account for that.
This is just a short term.
Yes,
we don't have to account for it.
Yes,
but I think for a lot of people that were like, "Uh-oh, my estate's larger than $5 million," is probably what it was set to revert back to. But who knows, right? I think now people.
I wouldn't worry about it as much.
No,
yes.
I wouldn't rush to do any estate planning in the next 14 months.
Yeah, and you'll know in the middle of next year. And we talked about it. We've talked about it multiple times about why this is really important. We did, 3-4 weeks ago, we talked about depending upon who takes the House, the Senate, and the presidency, that you may want to address this. And so everything we said 6 or 8 weeks ago about being concerned about it, I wouldn't worry about it.
That's right. Exactly. Well, we saw how things come. Anyway, if you want to join us, you can send us an email, questions@moneymatters.com. Or give us a call, 833-99-WORTH. And we're starting out with Rex. Rex, you're with Allworth's Money Matters.
Yes, sir. How you doing?
Good.
I got a question for you. I have a cell tower that was installed on my property 4 years ago.
A cell tower?
Oh, cell tower.
A cell tower. Yes, sir.
Okay.
Cell phone tower.
Yep.
And it started out at $11,000. $11,000 a year, a 2% gain every year. And I got 26 years left. And I have a company that wants to buy me out. Do you recommend to ride it out or take the buyout?
Well, and so so when did you put this thing in?
4 years ago.
Okay, so you have a 30-year lease on this, right?
Yes, sir.
And it's a triple net, so basically there's no expense to you whatsoever.
No, sir.
Zero.
No
and so you get $11,000 a year. That increases at 2% per year.
Yes, sir.
What are they offering to buy it for?
If it cash out $170, 5 years $190, and 10 years at $225.
I don't know what that means.
What do you mean 10 years?
10 years, $225,000. That'd be $22,500 a year.
Oh, they're going to take this payments and pay you over 10 years.
Yes, sir.
Okay.
And who's the company that's doing this, that's offering this?
The one that owns it now?
Yes. One of the things that you're worried about.
My guess, it's a third-party financial company.
That is
I'm just curious if that third-party company approached you directly, or they're working with whoever the company that installed the cell tower and who's handling the finances.
Or a third party altogether.
I reached out to a couple different companies that buy out cell tower leases.
Okay.
And this is what they came back with. But my cell tower people, they have a clause in there that they have a third party where they have a chance to buy it before they can.
Yeah, first right of refusal, correct?
Yes, sir. Yes, sir.
And what's driving
future.
What's driving you to do this?
The future, because of Leon Musk is doing the solar.
Starlink?
Satellite link.
Yeah, Starlink.
Oh, so you're concerned that the payments aren't going to be there 26 years out?
Well, they can pull out at any time they want to.
Wait,
but no penalty.
They can tear that cell tower down anytime they want and quit paying you, and just quit paying you anytime.
Yes,
that right?
Yes.
Oh, I'd sell it.
You would sell it?
Oh, heck yeah. Look,
Okay.
look, and I try to get the highest price.
Yes, sir.
But you're selling a stream of income in the future that you're afraid is going to go away.
It could go away. Yes, sir.
Yeah. And so you've got 26 years on it, and they want to pay you $22,000 over.
Yeah,
what's the lump sum? Tell me what the lump sum is.
170 is a lump sum.
Yeah, I mean, it unfortunately makes really boring radio to crunch numbers. It's just a mathematical.
It's a math.
But my guess is there's probably 8 or 9 or 10% internal rate of return that's calculated for the investor, if not more, because of the risk
of them pulling that tower.
Yeah.
Yes, sir.
And they came out of the box at 170.
Yes.
I'd ask for 190.
Okay.
And maybe split over 2 calendar years.
That's not a bad idea.
Would you do the 10-year plan?
No.
Or you think they could go out of business and?
That's look. You're doing the reason you're doing this is because you believe that there's an inherent risk.
Yes.
But
yes, sir.
But if you really believe that, there is not only an inherent risk to you, there's an inherent risk to the buyer of who's buying that cell tower.
And it's they've calculated in that price. Someone's willing to take that bet.
Right.
Yes.
And are you selling an easement or are you selling that little plot of land?
No, it's just the easement, not the plot of land.
And where does this easement sit on the property? Is it in the middle of the property? How big is the property?
17 acres, but it's only on it's like a 50 by 50 or 100 by 100, something like that.
Is it in a corner, the middle?
Yes.
It's in a corner. Oh, brilliant. Very, very good. So you wouldn't, like if I bought that property and there was an easement if I bought it from you and there was an easement on it, unless I was deathly afraid of cell waves, whatever they are,
Right.
I'm not a scientist. And even if I wasn't a scientist, I should probably know what they are. But yeah, I would
only because of that risk.
Because of that risk.
Okay.
And that's actually, I've never thought about it before, but that's a real risk.
Yes.
That's a lot. 26 years in the world of technology is a long time. Think about 26 years ago and how much communication has changed.
Yes.
Yeah. Ask your kids if they know what a rotary phone looks like.
They don't.
Yes.
Nor are they that interested in talking about it either, Pat. Like, oh, good for you, Dad.
Okay.
But you know how fast technology changes.
That's
right.
right. That's why I agree with you 100%.
But I would push them on price, and I agree with Scott. I'd have it paid out over 2 calendar years just for tax purposes.
Yes. Well, that's why I was thinking the 10-year, but if they could go bankrupt and go out.
Yeah, they're betting.
I mean, before I did this, I would crunch the numbers to have an idea of like what kind of hurdle rate, what rate of return would I need. But even the 10 years, like
At 10
pretty
years at
quickly.
$22,000 a year, is that what you said?
For 10 years, yes, sir.
Yeah. Well, you know that their hurdle rate's probably somewhere around 7 to 8%.
or higher, because they might view this as a.
Well, then maybe they're just picking them up to repackage and sell off. Who knows? But
Yes.
have you gotten another quote from someone else?
Well, the people that own the lease now, they offer me like 140,
Okay.
and then this other one said 170.
Well, just see I'd get the maximum price. I would try to. I mean, if you can pull this off, do half in December. I don't know the rest of your financial situation, but assuming everything else is static, I'd do half in December and half in January.
Okay,
Yes.
sounds good.
Yes.
That way you can
sir.
spread the tax over 2 years.
Yeah. Good for
Because
you.
Yeah.
Good for you.
Yeah, it started to just to be a piece of hunting ground, but turned out to be getting paid to hunt.
Yeah. And so there's no houses around it?
No, not,
Oh, even
not
better.
close.
Oh, is that right? And how's your cell phone reception there?
Not good.
It's literally not.
No, it shoots above us.
That's hilarious.
That's funny. And the whole reason I wanted the cell phone tower on my land was so I got good cell reception. That's great. That's great. Yes. Push up for money and take it over 2 years.
Okay, sir.
Yeah, I
Sounds
think you're
good.
wise to look at the risk on this sort of thing. And you really, like, for other listeners that don't have the luxury of having a plot of land they can lease to a cell tower company, it's the same concept you would consider on whether it's owning a company and like, what's the probability of this being viable company 25, 30 years from now, or even more so to think of it as like a bond.
That's right.
And
the more risk there is, right?
Like what's a prominent company that's gone bankrupt lately? I can't.
Well, I mean, we could go back to WorldCom. And,
no, lately.
What would be a better thing for you to answer is which ones are going to go bankrupt soon.
Well, okay.
That would be valuable information.
Looks like Spirit Airlines. You follow that story?
Yeah,
at all?
but TGI Fridays.
TGI Fridays.
What, last
Who would have
week?
thought?
I know.
When was the last time you heard of TGI Fridays?
I don't know. All I remember is from the working spaces where Jennifer Anderson got in trouble for not wearing enough bling.
That wasn't TGI Friday though. That was.
It was the same thing. They called it.
What was that? That was.
Working spaces.
Office space.
Office space. Yes. The one that runs every Saturday at 2:00 for people that only have the people that don't.
I think that pretty much is, if you're an old white male, it's a pretty funny movie because other than that, I don't know.
Okay. All right.
But I lost my train of thought with. So anyway, thinking about the same way you'd want to consider the risk of a bond.
Yes.
At least with a bond, the market changes every day. The price changes. You know what the value is.
Yeah, and here
something obscure like this.
But I think that I've never thought about Starlink. But I'll tell you, in third world countries, they're not building cell systems like they would have because of Starlink. It's just easier to stand it up.
Well, you know, I've had a small cabin in Tahoe, Lake Tahoe, for 20 years or whatever. And I have my internet provider. It's this repeater system of some sort. It's totally janky, right?
It must be awful. They have a house at Lake Tahoe with poor internet service.
Yeah, but it's just like you've got this satellite-looking dish that goes across the mountain, and it gets a repeater thing. Anyway, a couple years, up until 2 years ago, the thing always had challenges. And if you remember years ago, Pat, we would do our show remotely. Sometimes I'd be up there, and it seemed like 1 out of 3 times something would be wrong. Since Starlink became available, my service is almost perfect.
Oh.
It's amazing how they've really upped their game.
Isn't that?
And it's the free markets.
You love it, don't you? You're just like, this is competition.
Yes.
This is competition.
Yes. They had to up their game because before it was the only option.
Yes, this is competition. That's great.
All right, let's
anyway
continue on here.
Well, that was I enjoyed that call. I had never really. It was a new thought. It's like introduced new ideas that changed my view.
Well, what is it? I mean, I would certainly be thinking, what is the chance 26 years from now we'll still be using these cell towers?
Yes, or driving your own car, or drive. Look, my nephew and I've been following Whammo in San Francisco.
I rode in one a week or two ago.
How was it?
It was surreal.
All right, before we go to the next call. Okay. Well, I'll tell you, Andrew's been waiting, so let's make a note
take
here.
Andrew and then
This thing might run longer than an hour, Scott. So I want to talk about all work, making the notes.
Okay.
Why we named, someone asked me
You
why
can
we
see how much
changed our
prep
name.
work is done with our
and
show.
then we're going to talk about Whammo and Scott's experience. All right, anything else anyone wants to talk about?
I'm glad you're
Well, because we bring up topics we're going to talk about, and sometimes we don't talk about, but I've got notes.
Yeah, well, there is a little bit of prep that goes in the show. Anyway, let's talk with Andrew. Andrew, you're with Allworth's Money Matters.
Hey, gentlemen, how you doing? Thanks for taking the call.
Thank you.
So I have a question about what to do with some after-tax money to invest. I got a promotion and a raise recently, and ended up with a surplus, and so I've got about 36 to 40,000 a year looking ahead to next year. I've maxed out all of the pre-tax stuff I can do. And I'm kind of thinking, I had it in a high yield account for a while, but realizing that interest is just kind of kicking up, and the money's great, but the taxes are great too on that. So
how old are you?
I am 49. I'm in public safety, so I could retire as early as next year, but I probably will end up staying about 5 more years. And
you'll have a pension that's going to be roughly equal to your pay now?
It's going to be a bit lower. Lost some years in the divorce, so if I go soon, I'd have to work those 5 years to make it roughly equal.
And did you buy airtime? By the way, this listener, just based on the area code, is from the state of California. And if you're a safety worker, which means you're in law enforcement or work in a prison, it is some of the richest pension benefits in the U.S. Fair statement,
Oh,
Scott?
yeah. You know, it's funny. So, and I have a good friend of mine. I've got a couple good friends that are retired CHP. And one was complaining because his cost of living is only 2%. And what, but as he's telling me this, he says, I know I shouldn't be complaining about this.
That's correct. So that for the rest of the listeners across the U.S. and overseas, both of you, their pensions are fat pensions. So do you have a 450?
Which is one of the reasons that people stick in the.
But you have a 457 and a 401k available to you, do you not?
Yes. So I've maxed out my 457, and I've been doing the pre-retirement catch-up. That's part of why I'm going to end up with so much surplus next year, is I've been doing the pre-retirement catch-up up to the stated age of 50.
But what about the 401k?
You know,
I'm using a 401 to backdoor a Roth.
Oh
Okay.
no. Okay, let's.
No, he's using the 401k for a Roth.
But not. Are you putting the maximum in both the 457 and the 401k?
Yes, the 401k, but that maximum is quite a bit lower. But yeah, I'm doing the maximum.
No,
I also teach part.
It's not.
Right.
It's not lower.
Okay.
It's
And you teach part time. How much do you earn teaching?
About $10,000 a year, and I have 100% of that going into the 403.
okay. But I think you have room there. The 401k and the 403b fall under the same guidelines, correct, Scott? But the 457 doesn't.
That's right.
Right? So what happens is when people have a tendency to look at these, they look at the 401k, 457, 403b as the same
And there's maximum limits,
on each one
both on each one, but also in aggregate
with the 403b
So-
and the 401k.
and IRAs. Yeah,
But there is not an aggregate limit with the 457.
because it's technically
It's
a
employee
deferred
deferral.
compensation,
It's a
yeah.
deferred compensation. It isn't a retirement plan.
You actually don't
per
own
se.
the asset until you leave.
So I think you probably have a lot of room left in your 401k and your 403b.
If you wanted to do it on a Roth basis.
So can I contribute more to a 403b than I make at that employer?
No, but you can contribute.
Yeah.
But you can contribute more. What percentage of your pay is going into your 401k?
Or how much annually is a question, dollar amount.
So I have an IRA that I use to backdoor. I don't have a 401k. I was under the impression that it was
Okay.
either or with government workers for 457
this
or
is-
401.
Nope.
Easy. Yep, it is the 401k.
Okay.
And you're going to be limited on, isn't it you only have to combine the 403b and the 401k
That's
for
right.
maximum limits? Yeah.
I believe so.
Yeah.
Don't quote me on it. So I think
So
your
that's a
limit
start.
I think your limit is what, $26,000 a year or something.
Yeah, it's something right around there.
And it'll go up when you're age 50.
Yes.
Yeah. Okay.
So that'll take care of some. And then do you have any money in, like, what do you have in savings outside of your retirement accounts?
I have, so outside of those retirement accounts, I have about 90,000 split up between a high yield savings, a lot of ETFs, because I listen to you guys and you guys say use the ETFs. Although I don't listen to some, so I have 15% in individual stocks that I just like to play
That's
with.
fine. That's
and then
nice.
I have about 20% in bonds.
So I just looked it up. So the maximum limit on a 401k and it combines with a 403b is $23,000 for 2024.
So there's another 13,000 I
Yeah.
can put into a 401.
Yeah.
And I'm assuming you don't have any other debt.
Mortgage
Yeah.
at 2.9%.
Yeah. You're not
Yes.
touching that.
Yes.
I would just continue to build up. I mean, in a perfect world, you get to retirement, you've got a nice pension, you've got money in a tax-deferred 457, you've got money in Roth assets, and you have money in just brokerage accounts, because that way it gives you the greatest amount of flexibility when it comes time to actually spending some of these dollars, right? Because there's tax consequences on just about everything.
Sure.
And so the more diversification you have in your saving strategy, the better off you're going to be.
When it comes to withdrawal.
Yes.
So I would continue to do the ETFs.
Okay, so just as much as possible into those ETFs as a savings vehicle, and hope for long-term capital gains when you finally got to pay.
Yeah, and Are you living the lifestyle you want, though? Or do you?
I was kind of thinking the same thing.
No, I am. So I'm actually living the same lifestyle that I had about 3 years ago before I promoted. I just didn't change anything. I didn't let the increased salary creep into my life. I still travel. I'm about to go on a 2-week cruise with a girlfriend, and I'm doing the things that I want to do.
Perfect.
Where are you going?
Hawaii, out of San Francisco.
Well, you're going to take a cruise all the way to Hawaii.
Yeah.
How long does that take?
Long time on the 4 days getting there, 5 days getting back, and no cell service the whole time, which is one of the biggest draws.
That sounds pretty nice.
That's funny.
Getting away from everything.
So why'd you go on a cruise? That's funny. Yep, easy, and just put the between the 403B and the 401k, go to the maximum of 23, and remember at age 50 you have the catch-up provision, which. Whatever that means.
Yeah, you get a catch up. And
beginning
next year, there's even more for what age is it? 60?
60, something. Yeah.
I think it's age 60. There's more you can contribute.
Yes.
The challenge is there's still required minimum distributions. And even though they've increased the age, they haven't adjusted the table that's used, which is based upon, crazy as it sounds, a joint life expectancy between you and somebody 10 years younger than you. That's how they came up with this crazy table. But they have not adjusted that at all.
But they did adjust what happens to the required minimum distribution at death.
Yeah. And considering that we are now no longer, our life expectancy has been shrinking the last few years, one could make the argument that they need to shorten it, but that would be a horrible thing.
Okay.
I'm just throwing that out there.
Okay,
anyway, glad you called, Andrew.
Thank you.
Have fun on your I think I mentioned last week, I had a very new experience last week. I performed a wedding ceremony for the first time. I was the officiant.
Oh, you did?
Yes. My niece, someone else was supposed to do it and called me at the last minute.
That had to make you feel good. Second, hey, Uncle Scott, I know you're
gone through the list.
You're very religious.
They couldn't find anybody.
I know you're very religious, but my friend Jimmy, who's 26, he's in jail. Can you please do it for me? So how'd you do it?
I don't think it was that big a list. The main guy fell through, and they thought, well, what's funny about it, I've done, like you, Pat, hundreds, if not thousands of public speaking engagements and doing this show. So I don't get nervous. I don't care if there's 1,000 people in the audience. I don't get nervous at all.
Yes.
I want to make sure I do a good job. But when it's somebody's wedding, like the gravity of it, like I don't want to screw this thing up, have to start over, miss something. It all went fine.
I did one last summer where I actually stopped in the middle of it when I said, and you, and then they, who said it? She said, yes, I do. And then and then they read to each other. And after that, when they're done reading, I just stood there and she looked at me. She said, well, what's next? And I said, I was just so engrossed by those words. And I had just blanked out. But then
you were so moved.
That's what I said. I was so engrossed by the beautiful things you said to each other. I just kind of got lost in the moment, which it wasn't that at all. I was thinking about whether I actually need to put new gutters on the side of my house.
You were not thinking that.
No, but I had kind of spaced out. But then I was at a funeral, my brother's wife, and my brother asked me to say something, and I got up and said, I got to tell you, I am a minister just like this man standing here.
Are you a minister of some sort of?
Yeah, American Marriage Ministries. It was like $25.
And then did you still have to get licensed to the state of California? Were you in California?
I was able to sign the.
You're a minister.
Yeah, American.
I'm licensed by the state of Hawaii. I'm just a
How much did it
servant.
cost?
Well, I had an option. It was $100 for a year or $25 for 60 days. So for the next 55 days or so, if anyone needs to get married in Hawaii,
I can marry.
I might be your man.
I think I can marry anyone
in any
anywhere.
state.
Kind of like a.
And how much would yours cost?
I think it was 40 or 50.
Do you have to do a test?
No.
Did you have to agree to some certain things?
Not that I recall. They sent me a beautiful certificate that I have framed in my office.
You're so proud of
my American Marriage Ministries.
Is that what it's called?
Yes.
American Marriage Ministries.
I don't appreciate you making fun of
yes,
this.
I think you do. It's funny.
But when I did get up and speak at the funeral and pointed out that I am a minister, so I have the same sort of, my words have the same gravity as this man that has studied it his whole life.
Yeah, he might not have thought it was funny. All right, let's continue on with calls. We're talking with Sam. Sam, you're with Allworth Money Matters.
Oh, hi, Scott and Pat. Thanks for taking my call.
Yeah.
So I'm trying to figure out, I just retired this year on April, and I'm trying to figure out if I'm going to be okay remaining retired.
Was this did the retirement date come earlier than you had planned, or was this like suddenly the company made it?
Yeah,
okay.
It's way early. I just hit 60 yesterday.
Okay.
Happy birthday.
Thank you. So I sold my business with a building, which I carried a note, and that would net me about $4,047 a month. And I also have a rental that I'm renting for $3,200, and my wife is bringing home about $4,000 net. So we will clear about $11,200 a month. But my combined expenses, because of the two mortgages I'm still having, and utility and insurance and everything, will come out to about $8,100.
Okay, so can we 1 second here, Sam? You sold this building. You sold this
Did
building.
you get it cash?
No, I'm carrying the note.
For how long?
It's a 20-year term with a balloon payment. But they have a payoff. Early payoff is 5 years. So anytime after that, he could pay off the whole amount.
And what is the amount?
About $600,000.
And your business was in the building, so did you sell the building and the business together?
Correct.
Okay.
Okay, and you received no cash up front?
$90,000.
Okay. And then, so the mortgages are on the rental and your primary residence, correct?
Right.
Okay. And what is the value of the rental?
The value of the rental is about $800.
And what do you owe on it?
$190.
And what's the interest rate?
1.875.
Okay. And the primary, what's the value?
About 1.1.
And what do you owe on it?
150.
And I assume the interest rate is probably about 1.8 as well.
1.9, yes.
Okay. All right. And what other assets?
15-year loans. Was the rental a primary residence at one time?
It was.
That's how you got the low rate then.
Right.
How long ago was it a primary residence?
30 years ago.
Okay.
But I refinanced. So I have a primary residence for 30 years, and I built a home, which I subdivided from my property. So I built another home, and I moved back here like 5 years ago.
Okay.
And what do you have sorry.
I never did rent it out. I'm sorry. The rental, I never did rent it out, so it was always a primary residence for both address. Because one is in the front, one is in the back.
Mm-hmm.
But it's on two separate lots.
Got it. Now you're renting it out.
Yes, now I'm renting it out.
And what is what other assets do you have?
And let me just real quick, is the $3,200 from rent, is that after the mortgage and expenses on the house?
No.
But you netted it out, the expenses as part of the $8,100 a month that you're correct?
Right. The $8,100 is including the two mortgages.
Okay. So what other assets do you have, Sam?
So I have about $210,000 cash. I have $100,000 of it sitting in a high yield account, and $100 of it is at a betterment with 90% equity in stock market and 10% in bond.
Okay. Anything else?
I have a retirement account which is worth about $382,000.
Okay.
With 220 of it is in IRA, and 150 or 160 of it is in Roth.
Okay. Anything else?
No, that's it.
And how how much longer does your wife plan on working?
That's my next question. If it's doable, the problem is her work cover my life my health insurance. So we were worried if it's doable. She'd like to retire at 62.
How old is she now?
60.
And how much does she make?
A net about $4,000.
Okay.
Her gross is about 80. I think 79, 80 a month. I mean, yeah, a year, 79 or 80 in a year.
So let's ask this question. And I'm not implying that you have enough or don't have enough. If you were to go back to work, what would you do, and how much would you make?
If I were to go back to work,
yes, because you said you don't know if you have enough money to retire. So I took the null hypothesis and said, okay, let's assume you don't have enough money to retire. What would you do? If you had to go back, you sold it. You've been self-employed for many, many years, I assume.
42 years.
Okay. So
I don't think he's going to be working for anybody. My guess.
The idea of you going in.
Don't forget to punch the clock on the way out.
Right. The idea of you going in and actually getting a job is probably not very appealing.
No, it's not. Well, I'm tired of it, so I could go back to work, but I don't know if anybody's going to hire me as a service writer. Well, I own a mechanic shop for 42 years.
Okay.
So.
But by the way, did you sell to a large institution?
No, it's a small shop, so it's another person.
So you want to know whether you have enough to retire?
I want to know if inflation going to catch up with me, and I'm going to be screwed when I get to 62 and 65.
No, you're fine.
Well, I'm not worried about you getting screwed between age 62 and 65. The concern is 80 and 90 years old.
Oh.
Yeah, and I'm concerned.
You're going to have Social Security kicking in. Your wife's going to have Social Security kicking in. And you may or may not choose to take it early based upon the rest of your financial situation. It seems like the rent you're receiving for the house seems a little low. An $800,000 house, and you're only getting $3,200 a month gross.
Yeah, it's a 1,600 square feet house, 3-bed, 2-bath. I think that's what it's go for in this neighborhood. I could get as much as 3,500, but
must be in a nice neighborhood.
It's in an okay neighborhood. I mean, it's not bad. It's in Pinot.
Okay, well that kind of explains it. And you plan on staying in the Bay Area?
Yes.
This is tight. This is touch and go.
I mean, you got about $800,000 outside of your rental and your home. You've got that other income that's coming in, but we don't know how. We know that that's only going to, at the maximum, it's going to come in for 20 years. Yeah. It could come in much sooner. So we need to make sure that at 20 years from now that we can replace that income.
Because if your wife quit her job, then the answer is no, you can't retire. But if your wife works till she's 65, and by the way, you're really smart to be concerned about the cost of health insurance. Because you should be. Because Medicare kicks in at 65, and you talked about her retiring at 62, and it's conceivable that your insurance payments are $2,000, $2,500 a month.
Yeah.
Right? Which is $30,000 a year.
That's what I would figure, 20 to $30,000 a year.
Yes. So it's touch and go, right? If she was going to work to 65, and then you looked at what your Social Security was coming in and what her Social Security is coming in, my guess is that you'd be able to make up that $4,000, hit in pay.
Oh yes, you're gonna get a pension too.
Okay, well that's how much. How much will her pension be?
About I think it's 65% of her wages, max.
Okay.
That'll help a lot.
And she's Social Security eligible. She doesn't have a job where she did not participate in Social Security.
She could draw Social Security too.
Yeah, you're probably.
I mean, in a perfect world, if we talked in January, we would say, Sam, why don't you put it off a couple years? I know you've been doing it 42 years. If you can put it off a couple years, you'll probably be better off financially. Let's focus on doing all those steps that we should be taking now to put you in the best position for when you ultimately sell your business.
Yeah.
But we didn't talk in January. We talked now, and maybe that was still the right thing for you. I don't know you.
And what's the value of the building that you sold to them and carried the note on?
600.
So the business was just thrown in for free.
Yes, I mean, in my view, the business only worth something when I'm there.
Yes. Well, that isn't 100% true because there's
goodwill.
There's goodwill.
Right.
But so the idea that the reason I asked that question, which is that, payment at risk? And the answer is probably not, because of the fact you can go back and take the building if they default on the loan.
Right.
So you're probably okay. It would, if you're using Betterment, right, and you're paying them to do some financial planning, you would probably be well served to actually sit down and pay someone to actually do some projection.
Full planning, yes. And
Wait, I'm not paying Betterment. It's a robo account.
No, you're paying them.
I am?
Oh, yeah.
not much. Yeah, you're getting the low cost. You're getting what you're paying for, though.
Yeah. But it's not free. It's not free.
But part of the plan, Sam, is like, how do we replace that income 20 years out? And like, what happens when our utilities continue to go up? Right? Like, and property taxes, although they're limited in California, they still increase 2% a year. 2%, 1.5%, whatever.
Yeah, it's not. Let's just put it this way: you'd probably be okay, but I don't think that that's the right answer. Like, if
at a minimum, just pay to have someone do a financial plan for you.
I would never say to my brother, "You'll probably be okay." I'd say you need to actually go and pay someone to do a financial plan for you. A third party that actually says, and I said it to my own brother. I said, look, I don't want my brother-in-law. I don't want to be your financial advisor. We're too close. You need to talk to a third party. Fortunately, they used Allworth. I'd probably be insulted if they didn't. But it is someone else giving the advice. And I paid for his financial plan. I said, I'll pay for you to do the financial plan. They found out he could retire in 2 years, and he retired, right? I would recommend the same to you.
So what would be the cost for somebody to sit down and plan my financial?
Talk to the particular provider. What's the cost?
Maybe a couple grand or something?
Couple grand, but what's the cost if you don't do it?
Uh-huh.
I mean, like Pat said 5 minutes ago, this is kind of on the bubble here. So
it's not. I was hoping you'd come back and the other assets would be in the millions, and then I'd say, don't worry about it, but they're not. So it's on the bubble.
No.
Look, my guess is that the advisor is probably going to tell your wife she needs to work till 65, and that you're going to have to do all the shopping, cleaning, and cooking.
Nothing new is there.
Okay.
All right, Sam, our recommendation is do the plan, involve your spouse with the plan. You can look at it. The numbers aren't going to lie. I mean, you obviously have to use some projections in there, like what are we going to assume for inflation? What are we going to assume but just be relatively conservative on that. And then you'll have an idea of what your probability of success is.
And not only that, it would include your estate plan, what you're doing for estate planning, and make recommendations there and tax planning. So I think it's money well spent.
Yeah. Wish you well,
appreciate
Sam.
the call.
Yeah.
So,
and I would probably be tired being a mechanic for 42. Pat, I am so bad. I won't even tell you.
Okay.
I screwed something up the house. I'm just like killing myself. Like, why, the sparks.
Did you try to do it yourself?
Sparks and the thing.
The sparks.
The thermostat thing.
Okay, that's just not.
I thought I turned the power off. I went outside and flipped the switch. It was mislabeled or something.
Oh, you're lucky you're sitting here.
I'm not gonna get killed off a. I guess I could, but
yeah, people die from electricity almost every day. So yes. They
the smoke.
So
anyway,
someone asked me the other day. So for Scott and I've been working as business partners for 31 years, something like that. And up until 5 years ago, it was called Hanson McLean. And
if you listen to it on the radio in Sacramento, you still know Hanson.
Hanson McLean. Some lady asked if she could have a selfie with me the other day. That's never happened to me before.
Really?
Yes. Yes, a selfie.
Look at you, Pat.
I know.
It only took 30 years.
No, I'm an overnight success. I said to her, really? Really? So someone was asking me, why did you change your name to Allworth? And I said, well, look, it was Hanson McLean. At first, it was Hanson McLean Retirement Group, and then it was Hanson McLean Financial. But Retirement Group sounded like we did pension plans. And financial, we could have been a mortgage company or a broker or, we could have done auto loans or whatever. And the reason we changed it to Allworth is because as we've grown the business over the last 30 plus years, we've added more services. So we've added estate planning. We've added where there's estate planning attorneys on staff. We've added a large suite of accounting services for individuals. And where appropriate, our advisors will bring that in. Plus, we've got relationships for Medicare insurance and for someone like Sam who retires prior to Medicare kicking in. We have a third party that we work with under a white label that actually makes recommendations, and the advisor actually walks the clients through the recommendations. So I was sitting with an advisor and a new client the other day, and, as they explained it to, look, the new client came in, we took their trust, we downloaded it into our system, we scan it for highlights, right? And then we have an estate planning attorney look at it and then make recommendations to the client that may or may not be appropriate. And then the client can either have us institute or bring it to a third party. That's part of All Your Worth. So,
and an insurance division that analyzes whole life policies and that sort of stuff.
And annuities and long-term care policies, right? So we've got specialists in that. And, as the company has grown, it's, 30 years ago it was you, me, and one person. As the company has grown, we've been able to add more and more services, and we wanted that to be reflected in our name, Allworth, which is trying to create a one-stop shop for most of our clients so that we can take care of all their worth. Yeah.
So, and this, by the way, this is where the industry's headed. So there's the independent advice, like we've been independent for 30 years. It primarily had been almost a cottage industry. So tend to be a lot of smaller organizations, but it's really hard to provide all these services as a small organization. It's almost impossible. So part of our growth is finding other firms that want to partner up with us. We find some of the best financial advisors in the country.
And then we bring them a suite of services that
become part of
their client. So it goes back to Sam's question, which is, he's worried about whether he has enough to retire. And he was, bright enough to worry about the cost of insurance, but we would actually price the cost of insurance and wouldn't just guess what it will be for him, right?
Yeah, a true plan.
A true plan, and then bring in estate planning and tax planning around the whole things, and then talk about the risk, right? The risk associated with his financial plan. And the question was, well, how much is it going to cost? That's when he was like, how much is it going to cost? Mm-hmm. Well, visit with the advisor and they will quote you a price. And then if you don't want to pay for the plan, then don't pay for the plan.
Yeah.
Right? It's
interesting that you're talking about all this. I write a column every other week for a publication called Investment News.
I haven't read that in a long time.
None of you listening read it because it's
including me,
including Pat.
I used to, but now they started. Okay, keep going.
Yeah, I don't know why you don't anymore.
I don't
think I pay anything. I shouldn't have to pay. I write from every other week. Okay. I think about it. But the reason I brought this up is you were talking about that. The article I just finished writing this week was about aging advisors, and you either do your clients a service by really staying in the game or retire and get out of the way and have someone else come in and step in. Because things have changed so much in the last even decade. As you're talking about all these services, right? A decade ago, we weren't providing those services.
No. And in fact,
and then you think of the technologies.
Well, a few years ago, estate planning, what we're doing today, you really couldn't do because the technology didn't exist. And I hate to use the word AI, artificial intelligence, but we use it. I mean, it's a buzzword, but it actually really adds great scale and efficiency.
Yeah. So my point of this article is like, your clients might love you and might think you're doing a good job, but if you're not keeping up to date with all the latest technology and all the latest services, you are not helping your clients, and you should probably just retire.
That's right.
That was what because the average age of advisors in our industry is late 50s. Early 60s. There are more certified financial planners over age 70 than under age 30.
Oh, I didn't know that.
More certified financial planners over age 70. These are people that keep up to date on their continuing education and pay their dues.
I didn't know.
So now there's some great advisors. I've also seen a lot. I've seen enough of advisors that they get to a certain point. They client books. They
retire
clients.
and don't tell anyone.
That's right. They golf 3 days a week. They travel all the time, and they don't really keep up. They don't keep up to date with everything.
Yeah, and they don't tell their clients that they're not really keeping up to date. Right? It's not.
When the clients don't know what the new things
right.
out that they missed out on.
All right. Well, anyway, there is, not to belabor the point. So.
And what we didn't talk about at all is that the Feds cut
okay, but let's
cut rates a quarter point.
So we'll go a little long today for the podcast. We normally don't, but do you have time?
I've got time.
Okay, I have a couple minutes.
Yeah. So if you're listening to the radio, we'll have to drop off at some point in time.
Yeah. So
and if we drop off abruptly, then you know what
you can find us. At
so the Fed. So
All Worth Money Matters.
So I literally came in the studio midday. I had not listened to or read the news in a couple hours. And I see this article dropped on my desk of
quarter point.
Federal Reserve cuts key interest rates by a quarter point. And I look at this like, is this today? Like what?
And the markets did nothing.
And the markets did nothing.
But yesterday the markets did so much that it made up for whatever's today.
And the bond market sold off a bit.
That's right.
Too,
and so
on Wednesday.
So one of the things to keep in mind here is this is not an automatic translation to mortgage rates. In fact, mortgage rates in the last couple months have gone up.
And this week have gone up.
By over 0.5 percentage point. Not this week, but over the last month, I think it's been up 0.7% from 6.1 to 6.8, right? So it tells you that what the Fed is doing and what they believe the long-term growth of the economy is going to look like is reflected, right? So the Fed is a consensus of people that sit on the FOMC. Is that correct? Yes. Board. And then the market is what controls long-term interest rates. And so it was 6.8 to.
Well, they control a bit by they can buy bonds in the open market, which they do as well, but
not
the primary
not as much as they once did. And sell bonds into the open market.
But obviously the market had priced this in fully,
That's
right?
Yes. Expected it. But we're seeing it overseas as well.
Yeah, Canada just did it a week or two ago.
I guess that's not overseas. Unless
well, you could get there by sea.
Okay, I guess
it's not.
Right.
They probably have more coastline than we have.
Okay.
Anyway,
this is not a geography show.
So start factoring in Alaska. I don't know.
Okay.
I don't know what I'm thinking.
Okay, Scott. All right. Well, you're going to have to discover that on your own time. So before we talk about your Whammo experience driving in
it's not that big of an experience. But.
Well, I'd like to hear about it. Not enough that I'd actually go to San Francisco and drive in one of those
Other cities have them. Phoenix has them. I don't know how many cities have them.
So Vanguard just paid a $40 million fine.
Oops.
Right? And what did they pay it? They paid it because of their asset allocation funds. They're called target date funds that work very, very well inside of
a retirement account.
Inside of a retirement account.
Because they'll shift allocations, and if it's in a retirement account, who cares about the tax consequences? Because there are no tax consequences on transactions,
right? But
only withdrawals.
But outside of a retirement account, you have no way of controlling, as is in many mutual funds, the taxation of them.
Yes,
as in many, especially actively traded funds. So the reason I point this out is because these were all the rage a number of years ago, target date. And they're great for small amounts. If you're new to savings, in fact, years ago, you talked about, you recommended one to your daughter.
Yes.
But if someone came in and put $200,000 in a target.
That was also in a time when transaction fees were much higher.
That's true. That's right.
I mean, because you can build a portfolio of ETFs even with $10,000 and have several.
Good point. Good point. So the point being is that the reason I bring this up is that you need to pay attention to what's happening in your brokerage account, not only the investments, but the taxation of those investments. Because
with this, they reduced
fees, and it created more.
They swapped funds out for an institutional class. They increased. They
bring
reduced the fees, the minimum for institutional clients, way down, and so they converted a bunch of people, and in that conversion process, triggered a capital taxation for them.
Yeah, but they would trigger a capital gain anyway that the investor would have
Eventually.
no control over. Yes.
That's
so
right.
just the point being is, if pay attention to your brokerage accounts and the taxation on those. All right, Scott, Whammo.
It's not that exciting. Is it Waymo or Whammo? Whammo. I don't know. Waymo.
Okay. So what? You're in San Francisco.
So I tried using it a couple months ago. I was there with my wife in San Francisco a couple months ago. We were going to use it to go to a concert, but I looked at the app, and it was going to take like 18 minutes for the car to get there, and it was like a 14-minute walk.
Okay.
So it was an easy decision. So we're just going to walk.
Okay.
But then I was there. I was in a conference a week ago, and I'm like, let's try. I was with a friend. Like, we're going to dinner. Let's try Waymo here. It was surreal because the car has a steering wheel.
It does.
You sit in the back seat. I guess you can sit in the front seat too, not with the driver's seat, but the passenger seat if you have that many. And you just watch the wheel turn. I mean, clearly it doesn't need a steering wheel, but it has the steering wheel.
And so,
So I ordered the thing on an app.
Okay.
And there's a flat rate. It's like $7 or $8 right now. I'm just trying to get people to start using it. And so I went to the front of the hotel, and I guess I must have had the wrong thing. So anyway, it went to pick me up a block and a half away. So I had to walk the block and a half. And as I was walking the block and a half, it had to go do a loop around the block because it couldn't stay parked there. So I got a notification that it had to move somewhere. So by the time I got there, I had to. You got to open the.
You open the doors.
You push a button on the phone, and it unlocks the doors. All of a sudden, the doors unlock, and you get in. And what was surprising to me about it, same thing with
that they still talk to you. The driver that wasn't there actually came on a speakerphone and still talked.
There's actually not some guy behind the curtain with a little joystick.
We find out that these are all driven remotely from the Philippines.
The whole center,
and they're all in cars,
like those driver training things you had in high school. Right?
Exactly. Okay, they got a whole bank of them.
But what was surprising is the speed in which the car would accelerate. I mean, I just assumed to be really slow and smooth, but I mean, I guess it's a city, so you want to pull out. There's traffic.
Just boom.
That's exactly how it drove.
And you can't tip. You don't have to tip. I don't tip anyway.
No,
I'm joking. I'm joking.
Anyway, that was my Waymo experience.
And you do it again?
Oh yeah, 100%.
Yeah, my nephew.
As a matter of fact, I mean,
my nephew says that's all he uses in San Francisco.
Well, yeah, I totally. I mean,
he said
it took a little.
He said
I had trouble figuring out how to unlock the doors. My app had froze, so I had to shut the app down, open it back up. So it was a little. But once you do it once or twice, then it's pretty simple.
It is. So this goes back to when we were talking about cell phones, and the gentleman that's got a 26-year lease left on his. Who knows?
So today, my son's first day being a co-pilot in a commercial jet. I'm not going to tell you the airlines right now, just in case you're flying today. Okay, I don't think anyone's going to announce. Oh, and the co-pilot, Blake Hansen, by the way, it's his first day. Right?
Everyone, congratulations to Blake. Right. And he brought a Scooby-Doo lunchbox.
Yeah, the surgeon's great. You might be his first patient, but I'm sure it'll go fine. But so even just interesting about his, like, planes don't really need pilots.
That's right.
Right? Particularly in the cockpit. I think they're there, one, to help the passengers feel much better.
I would not get on a plane without a pilot.
Yeah, one thing about getting on a car that's going 20 miles an hour as opposed to being in an airplane. But how many years before we only need one pilot?
Yes.
When you're comfortable enough with the plane, it's so rare that something goes south.
Yes. Yeah.
The changing of times.
It is. It's interesting.
Anyway, all right. It's been fun being with you. This has been Scott Hansen, Pat McLean.
Yep, and join us next week. Oh, and by the way, this goes back to Sam. On our website, he sold his business and someone had an offer without doing financial planning. We see this a lot. And on our website, we have an emergency guide to retirement so that if you are displaced,
something you retire earlier than you planned, something
and
happens.
retire earlier than you planned, this kind of walks you through the steps of what you should be doing, what you should be looking at. And it's the emergency guide to retirement, I believe.
I don't know.
I think so. It's on our website.
Anyway, we'll see you next week. This has been Allworth's Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.